All right, so we are talking today about advanced charitable giving techniques and awareness. And as many of you know, this is part of a project by LegacyWise in terms of introducing some folks to a variety of issues related to charitable giving and estate planning, so that someday those folks might be willing to participate in a program of assisting folks who really don't have resources to hire lawyers to do their estate planning documents at a cost that's much lower than what they currently would be charged. So that's just the context. And one of the issues there is the issue of what do we do with charitable gifts. So I'd like, if you have some questions, and you don't have to be discouraged by the volume of people in the room, if you have questions, ask them along the way. Even though I teach for a living and have done it for 27 years, I teach in a style that is not a lecture format. And so really the longest period of time that I commonly would speak without interruption is maybe 10 minutes. So please ask questions along the way. It actually helps me out as an instructor. So, charitable giving is a general proposition. I think what you see in charitable giving is that you have a charitable inclination. Somebody has a desire to make some kind of charitable gift, and we couple that with a particular motivation. So, what is it that motivates them to do something at that particular time? A motivation alone is not enough, in most cases, to make people who have no charitable designs make charitable gifts. And charitable giving typically is not enough without some other motivation. Now, that motivation may be a work of the Spirit through the Word to motivate someone. It may be a tax motivation. It may be something else, but it usually connects with an already existing charitable inclination. So here are the things that I think are helpful for us to think about as we work our way through these charitable giving techniques. And I'll make some comments about this along the way. So, questions to consider. First, to whom would the charitable gift be given? And should there be, in a plan, any non-charitable beneficiaries of that gift? So we'll talk about split interest gifts later, where the charity has a portion and where the non-charitable beneficiary has a portion. Then the question becomes, if you've decided to whom, the question becomes how much? And in my thinking about this, that is almost always a question during life that is a question about imminence and amount. It's a calculus. The more quickly one decides, or is likely to decide, is related to how much it is that people give. So, if you are not being required to give much, you can make a decision pretty quickly, right? If you are thinking about a large amount, then it takes much more time to make that decision for most folks. So, the example would be, you're visiting a church, you haven't been there before, you just happen to be there on a Sunday. The plate comes by. You got some cash in your wallet, you give it. That's an imminent decision. It's not very much. But it's unlikely that that'll happen if the amount goes up to 100 grand, for example. All right. So, then the question is when, and there I'm also suggesting that idea of amount and imminence is at work. Do we want to do it during life, or do we want to do it at death? Yes?
One thing I wasn't sure, this is an interesting illustration. It's one of the Jane Eyre movies. I think it might be Sense and Sensibility, in which the movie begins with a death scene where the father says to the to his stepson, I believe, take care of your mother. And then the movie progresses and it shows, he says, first, give her this much, and then he's walking along and you see him thinking, she doesn't really need that much. The time goes by, she doesn't need that much. And ends up by the time he and his kind of miserly wife have figured out they put mother and the daughters kind of in the poorhouse almost.
Right.
In terms of evidence, in terms of the
Exactly.
mother was sure dad will take care of her.
Yes.
And it's a great illustration of what happens over time.
Right. It just becomes less compelling.
Yeah.
Right? When the moment is not so compelling, then our inclination to give can dissipate as well. So it's, do you do it during life? Do you do it at death? Those are questions to be considered. We'll talk about that as we work our way through. And then the rest of the questions are actually, in my estimation, the technical legal questions. So all the questions above, in many ways, are questions that are unrelated to law, generally. Now they can be related to law because we can have a few types of transactions where you make a gift now and you get some benefit for it, but the anticipation is that the greater gift will happen at death. So it's possible that those two things are related, but generally speaking, those matters of to whom and how much and when are matters that individuals have to settle in themselves. The lawyer can present some options, but the individual has to make those kinds of decisions. Then it becomes what? What asset to transfer? And in my mind, that relates to the next question of efficiency. What's the most efficient method and or asset to use in order to accomplish the charitable purpose that the individual has in the most efficient manner possible? So for example, if you have an individual who owns a business, it may be the most efficient way to address a charitable inclination to use shares of that business. Because there are ways in which that business, those business assets, can be very effectively used as a charitable gift. But that's a what and a method question. And then the last one is just a question of mechanics. How do you execute the plan that you have come up with? When you've got assets, when you've got an efficient method, then executing that method in light of those assets.
I hope you really mean it whenever you're willing for us to have conversation.
Please.
But one of the boards I'm on, I don't mean corporate boards, I mean
Right.
like
Nonprofit boards.
Email, updates.
Okay.
I work with charitable organizations, and one of the posters made a distinction that I thought was really, really good. It called it above the line conversations and below the line, which, like the legal, technical, you're going to use a CLT, a CRT, a CGA, all those are the technical below the line, but that's not what the donor really cares about. They care about how much, to who, when, and even the more above the line is why.
Right.
Do you want to leave a legacy?
Which
like
goes,
as a nonprofit, we say, what do you want to do? What do you want to say? How do you want to say it? Who do you want to say it to with your charitable giving?
Right.
Is like that highest level. And I know we're in the more technical class.
Right.
But I would even think for estate planning attorneys, it's really like getting at the heart of the matter.
It is.
And then getting to the solution.
Right.
And I think that's kind of what you're even talking about a little bit.
Right, and that goes back to charitable inclination and motivation.
Right.
So what is the charitable inclination? What's the motivating force right now? It might be legacy. It might be recognizing our mortality. It might be recognizing that there is a unique need in this particular moment, and I have the assets that could be used to accomplish that particular unique need or to address that need. So you're right, that's the big scale thing. And then the next one is, then we come to these other questions: to whom, how much, when, and then it becomes a technical question. What assets, what most efficient method, and what methods of execution are required in order to be able to accomplish the donor's goals. All right, some matters on the impact of the 2017 Tax Cuts and Job Act. So you've all probably heard about this. The personal exemption is gone now. It's replaced with a standard deduction that in 2017, the personal exemption was $450. The standard deduction was $63.50 per person, which totaled $1040. 2018, the personal exemption amount's going to be $0, and the standard deduction is up to $12,000 or $24,000 if married. The estimates are, in light of that increase of standard deduction, that as few as 10% of tax filers will actually itemize now. And so that raises a question of what are the impacts to charitable giving that result from that particular act. Contributions to charitable organizations, charitable giving, they are deductible. They survive the legislative process, stayed in the code, but there's an expectation that individuals who will not itemize may be far less likely to actually make charitable contributions because it won't impact their tax costs at all. It'll be interesting to see what happens, and it'll be particularly interesting to see what happens in the church, in my judgment. So we'll see. We'll have more data on that afterwards. The marriage penalty, as it was called, where you actually paid more if you filed married. I'm sorry, if you filed single, paid more if you filed married. Got it right that time. And then you did if you filed single. Well, that's been eliminated. So we have now, the brackets are twice what the married bracket is twice what the single bracket is, which was not the case before. Okay. Now we go to some of the mechanics, the types of things that individuals give and how they give those things to charitable organizations. The easy one is a gift of cash. A whole host of folks do it all the time. And again, those amounts sometimes tend to be pretty low, and so the amount of runway ramp before the gift takes place can be relatively short. It does provide an immediate benefit to a charity. I've never seen a charity turn away cash. There's a good reason for that. They need it, and it's now an asset that's immediately available to them. There are no basis issues for the taxpayer, the donor, when you give cash, because cash always has the basis of its face amount, and so you don't have to worry about that. With the new act, you can deduct up to 60% of your adjusted gross income now if what you make are cash gifts that are tax deductible. That's up from 50%. But there's also a bit of a concern that attaches to that idea as well. So it's likely that for many donors, this is, from a tax planning perspective, the least desirable asset to use to transfer. But it's also the asset that most donors have to transfer. They don't have other assets, really, in any sizable amount that they would use to transfer. So it may be the least desirable, but it's the most common. And so that's the reality of the situation. A more desirable asset to use, if it's available, is a gift of marketable securities. It's the second most common type of lifetime gifts. It likewise provides the charity an immediate benefit. The donor does not have to recognize the gain. So the transfer to the charity is the fair market value of the securities. Transfers of those non-cash items can represent 30% of the donor's adjusted gross income. Now, if the donor uses any marketable securities, no matter how little, it appears that under the 2017 Tax Act, you are capped at 50% of your adjusted gross income for cash. So, if it was just strictly cash, you have 60% of your adjusted gross income that you could deduct. If you throw in some marketable securities, they can't be greater than, or you get no deduction, you actually get it continued over to the coming years, but you get no deduction over the 30%. And you reduce your total down to 50%. So if you went to the maximum of 30 for marketable securities, then you can add another 20% of your adjusted gross income in cash. But you can't go to the 60 in that situation.
But, and I was going to ask this, but there is carryover. So if you get
Correct.
40% of your AGI,
Sure. You can carry it over.
you do 30% this year and 10 next, but then you could only do 20 more
Right.
next year, but maybe
Right.
it's a big gift this year.
Correct. That's right.
And is it 4 or 5 years? Or
5 years.
5 years.
So there's a lot of discussion now after the act about how people ought to give on an annual basis. And so some folks are suggesting, for example, that they bunch gifts. So instead of making 2 gifts in consecutive years, they make 1 gift at the end of the first year. The theory is you'll be above, most folks would be, above the standard deduction, so you have added a much bigger gift in that particular year. The next year, you go back to using the standard deduction. The next year, you bunch your gifts for 2 years at the end of 1 year. So some people are suggesting doing that. Then the same thing could be true with marketable securities. You do it. I do think that this common wisdom still works. And the common wisdom is that if there are some securities out there that you would be inclined to give out of the portfolio, and those are low basis securities, for example, that you don't want to have to sell because you don't want to have to recognize the gain, give those securities to that charitable entity in order that you might take advantage of the deduction that's available, and the charity now has those assets to be able to give. Again, this is all types of, very simple at the early stages, types of gifts that can be given during life. Here's another one, giving a life insurance policy to a charity. The donor simply transfers the ownership of the policy to the charity, and the donor receives an income tax deduction equal to the fair market value of that policy, which can be a replacement value or interpolated terminal reserve value, and I don't want to talk about that anymore. So the theory is this, and I think that this makes some sense, and I think that charitable organizations might not take as much advantage of this as they could otherwise. Common wisdom again, if the donor owns a paid-up policy and doesn't need that insurance either for the creation of an estate or the payment of some kind of transfer tax, then why not transfer that to the charity? The charity gets the advantage of that when the donor dies. Question?
I'm sorry, you mentioned the fair market value again, so that could, I know you only get too deep into that. So how is that, do we get an appraisal on that? How do we determine that?
Yeah, so you're looking for either the replacement value. So it's difficult for policies that have been in effect for an extended period of time to be able to identify a replacement value. Mm-hmm. That's difficult. So the second alternative is what the regs call the interpolated terminal reserve value. Mm-hmm. And that is designed to try to measure what is it that the insurance company internally would set aside to pay this claim. So that's the interpolated terminal reserve value, plus any premiums that have been made or paid, and then they're prorated. So that's what we're after. Now, it used to be the case, I've talked to some estate planners in the last couple of years on this, but it used to be the case that the insurance company would actually provide you with the interpolated terminal reserve value. But then that became an issue that might end up as part of litigation. What you owe in taxes, for example. So if you made a non-deductible transfer of a life insurance policy, and you make that this year, now you have a gift to a non-charitable beneficiary. That gift has to be valued. So you go to the insurance company would say, well, our interpolated terminal reserve value is X. Here's the problem. Then you put that on your return, and then the service comes in and challenges the volume of the gift, the value of the gift, and now you're back to the insurance company saying, hey, you gave me a bad value. And so they stop giving. So now they're much harder to get, so you have to get an actuary to try to...
There is a very recent California family law case in which it used to be we always treated term policies as worth nothing.
Yeah.
The recent California family law case, which actually has made the pot much more thick in the sense of, can the policy be valued, can the policy be replaced?
Right.
What's the age and health and all these
Right.
issues now.
And they mean something. I mean, those things, that policy, even though it's a term policy, actually has value. Because there are things about that insurance that are now available that wouldn't be available potentially later, right?
Exactly.
So you become uninsured. Now you begin to see what the value of that policy really was. And so those are difficult questions. So you get the same difficult questions here. But in these particular cases, there may be less incentive for the IRS to investigate these because you're talking about a charitable donation. The downside of that is you're talking about a charitable donation because you now have the donor's income tax to be reviewed at that particular point as well. So it's possible. All right, gifts of real property. It's not an uncommon transfer at all that people will give real property to charities. And sometimes the gifts of those real property, the gift of that real property, will be exceptionally strategic. For example, you have a college and you have property adjacent to that college. Well, the first rule, as I understand it, of colleges and managing real estate is buy every piece of property around you that you can. The second rule is read the first rule again. Buy every piece of property that you can. So if someone comes to you and say, we have these 15 acres that are adjacent to your campus and we want to give them to you, well, say yes. I mean, other than the possibility of some kind of environmental hazard, say yes to that. And those are great gifts to get, right? But gifts of real property or real property interest can also be very problematic gifts. I mentioned one. We have this toxic waste dump that we would like to give to you. Oh, sure, we'd love to have that. Or, how about this one? This happened at Campbell University where I teach. There is a wealthy lawyer in the Raleigh area who, I don't exactly know how he came by this, but he had a right to draw water from the Neuse River. Well, he was willing to give that away. What's the question? How in the world are we going to value that right? And if we can value it, meaning we're going to send some people out there, they're going to look at it, they're going to investigate, they're going to do a whole host of things in order to appraise that right. But the appraisal of it, which by the way, it appraised at over $8 million, the appraisal of it does not mean it's real money. You have to find somebody who's willing to pay you $8 million for the right to draw water out of the Neuse River. So that may well be a great gift. It could be, if there's a buyer. It also could be an albatross gift, because it's of no use to you, because you can't find a buyer. We don't, as a university, we don't want to draw the water out of the Neuse River. We can draw water out of the Cape Fear River instead. So it's of no use to us unless we can find a buyer. If we can find a buyer, it's a great gift. If we can't, then it's a gift that's booked on our sheets as $8.2 million, and it's of no value to us really whatsoever. And it's one of those gifts where it's like, do you wait and hold it? Do you hold it for 10 years to see if you can find a buyer that's willing to spend $8 million to buy that right? Or do you take $4 million now and get rid of it? Maybe that's the right answer. And then you have all kinds of prudence questions about, have you managed those assets rightly, which is a board question.
Maybe you can find some radical environmental group that wants nobody to have those rights and are willing to pay to get rid of it.
Right, and that's going to have to be funded by somebody who's got a lot of money, right?
Right.
To
But still, $4 million, that's a great thing.
That's a great deal.
And even if we sold it for 50 cents on the dollar,
Absolutely.
with $4 million of cash.
Yeah, I
and
agree.
you have an $8 million tax deduction because that's what the appraiser
I agree.
signed in his IRS form.
I
so
agree.
win-win still.
I agree. As long as you can find
As
a buyer.
long as you can find a $4 million buyer.
Exactly. But the point of it is, from the perspective of the buyer, why would you ever bid $4 million? How many people were in the market for this?
But then how'd the appraiser get to 8?
I don't know.
That's the question. It's an improper appraisal, maybe. more
Or
than
such
anything.
a difficult, it is, and this can happen again with gifts of real estate and charity, it can be a valuable gift if you find the right strategic buyer, right?
Yeah, like the farmer that
Or
doesn't have water down.
in most cases, it's actually going to be a municipality.
Okay.
They're the ones that want to have access to that water because they don't have enough access to that water now. So it's going to be a county or a municipality that can draw water from that particular river in that space, which is what it is. Now, for them, it is a strategic buy. There's no question about it. Problem is, there aren't that many bidders,
Yeah.
right? And so you're right. It's a question about whether it's a legitimate appraisal or not. So, what do you get? You get a fair market value deduction, get a large amount. From the donor's perspective, gets carried over into successive years. You can have a gift of a bargain sale, part gift. Those can be somewhat problematic as well. They become problematic oftentimes because of appraisers. Donors are looking for high appraisals in those situations because they're going to try to deduct the difference between the fair market value and the money that's received from the charity. So they're looking for a very high appraisal in those situations. That may not be justified or legitimate appraisal. That's something that you have to be careful about. And I put up here, mortgage property can be very tricky because you're talking about gain recognition and a variety of other things, and the indebtedness that the charity takes on, etc. So, but gifts of real property are the assets that should be considered as part of that collection of assets that would end up on the gift list for a donor. What could I give away? Okay, gifts of qualified charitable distributions from an IRA. This, I think everybody now is beating this particular drum, and I think for good reason. You have benefit to the charity. So what we're talking about is simply having a designation by the owner, beneficiary of the IRA of an amount or a percentage of the IRA going to a charitable organization. That money never touches the hands of the owner beneficiary of that IRA. Never touches the hands. It always transfers into the charitable organization. So, the charitable organization, when the check comes, has an immediate benefit. The donor doesn't get a tax deduction. Good news is the donor also does not have to include the amount that goes to the charity in the donor's income for that particular year. So it's a wash. So the classic example of where this would be useful is where someone is already in a place of minimum distributions from an IRA. Does everybody understand? You are past 70 the year following the year in which you turn 70 and a half. Those individuals then are going to have to take minimum distributions. They may not need the minimum distribution. They may continue to be working.
You said one item, to the donor, is a wash. A little more than a wash, because if the IRA distribution, if you want, he was taking, and we'll use 50,000, is coming over and into his return, it's going into adjusted gross income,
Right.
which triggers other.
Right, it could be. There could be other taxes beyond just the
More
deductible.
beneficial than just a wash.
Yeah. Yeah. So,
Social Security.
but yeah, right. Social Security
Taxability
issues.
of Social Security.
Right. Those kinds of issues. Right. The collateral income, collateral taxes to income. Right. It's a good point. So, the classic example again is the minimum distribution requirement. Money's going to go out, has to go out. If it comes to the donor, you have the tax issues there, plus the collateral tax issues that can come. So instead of having it come to the donor and then the donor simply writes a check in that amount to the charity, transfer it immediately to the charity. It never touches the donor's hands. That's a very useful thing to do, particularly for folks who don't need that money at that particular time and it's coming out anyhow. I have a good friend who's still teaching on the faculty at Campbell, and this is one of the things that he does in terms of charitable giving every year. He just simply has it redirected to a charity.
They just simply by letter to the charitable, to the IRA administrator?
Yeah, so there's a way to do it. Typically, each custodian will have a form that you, as a donor, can fill out, and the transfer will happen, and you'll get notice that the transfer has happened, but that's all that it is. You tell them how much, right? So it might be whatever the minimum distribution requirement of that year is, or you might want to go either higher or lower than that, right? So you might want to do the $50,000 gift in this particular year, or you might want to go less than that amount in this particular year because of some other concern.
One of the conferences I was at, this is also a way to get around the double standard deduction, because it never comes into income. You can still get the full standard deduction,
Right.
even though you haven't given anything, but you did because you
Right.
did it
Because
outside.
It never hit. Right.
It never came in. So,
Right. Right.
So it's one way to
you're-
if people were having issues or upset about that, they can strategically avoid standard deduction issues.
Right, so they can
with
keep, so that they can get the, again, it's an income issue, right? So you don't have the
Yeah.
income, you can still use the full standard deduction if you want to, but the charity's getting a benefit because you're making some kind of
They're
transfer
still
to
getting
the charity.
their offering or their tithe.
Right, their tithe, right. Question? Okay. So, yeah, the mechanics are really rather simple, and the documentation is provided by the custodian. It's a good way to make gifts. Now that so many people who are in my generation, the baby boomer phase, are now becoming those beneficiaries of those IRA accounts because they have put that money into their qualified plans over the years, and they've got a lot of assets out there. It's a very useful way for them to make charitable gifts. And it's of immediate benefit. Once again, it's of immediate benefit to the charity. Okay, donor advised funds. This is the deduction now and the decision later. So the definition of a donor advised fund is a separately identified fund or account that is maintained and operated by a Section 501c3 organization. It is a charitable organization, a separate fund or account. Each account is composed of contributions made by an individual, by individual donors, so it's sliced up, if you would. Once the donor makes the contribution, the organization now has legal control over that contribution. But the donor or the donor's representative retains advisory power or privilege to designate who will receive distributions from that fund. Now, does anybody know who the largest charitable organization is in the United States in 2017?
That foundation in Silicon Valley.
Fidelity Charitable Gift Fund.
Okay.
Fidelity Charitable Gift Fund, according to Forbes, was the largest American charity in 2017. Why? Because it's a donor advised fund. It's a 501c3 organization run by Fidelity Investments that collects donations from a variety of individuals into their separate funds, holds that money in each of those funds until it's designated to go to a particular charity. So it's the largest charitable organization.
I know with private foundations, there are requirements that
Yes.
income and so forth is distributed annually. That doesn't apply in donor advised funds.
Does not.
How about that?
It does not, and that's one of the big issues in the area of donor advised funds these days. And we'll talk about why there is some talk of making some changes and some regulations in the way. So again, Forbes said that $23 billion were deposited in donor advised funds in 2016. 23 billion. So, there's an advantage to the donor. What's the advantage to the donor? You get to take your deduction right now because you've made a transfer to a 501c3 charitable organization. You get to take your deduction right now. You get to provide for succession. That is, you get to make decisions. If you retain that advisory privilege, you get to make decisions during your lifetime if you want to, and then you can transfer the advisory privilege to successive generations if you want to. Is there a reason to do a private foundation instead of a donor advised fund? A lawyer friend of mine in Raleigh, a guy who is really a bright guy, he insists that there is never a reason to do a private foundation. I think he's wrong on that. I think there can be reasons to do a private foundation, but most people, I'm talking about 95% or more, do not need to do a private foundation and live with all of the collateral consequences that come with private foundations, the regulatory aspects of running the private foundation, the reporting requirements of the private foundation, the grant-making requirements of the private foundation. They have to make grants in order to continue their private foundation tax-exempt status. If they don't make those grants, they're no longer tax-exempt. And so, in most cases, a donor advised fund will work. So here's an example of where private foundations might sometimes work, but I think you can actually make an argument that the donor advised fund will work as well. So what if you want to create a scholarship program so that individuals, qualified young Christian individuals, can go to these institutions that they would not otherwise be able to afford? Well, a private foundation might work very well for that, right? There's a Mustard Seed Foundation, for example, that still is in existence and has done that for a while. Now, so you want to set one of those up. You could do it through a private foundation. But if there already exists a private foundation that does that, or there already are those charitable organizations that are running educational programs anyhow, couldn't you put your money in a donor advised fund and make the decision about giving money to these organizations that do those kinds of things? So as long as those things are in existence, I'm not sure that you really need to have the private foundation. But I think there's still a place for individuals, very wealthy individuals, to set up private foundations. But I think that's a very small space these days. I think the donor advised fund is much more compatible for the purposes of most donors. Now, what are the concerns? You can anticipate. There is no requirement now to ever distribute from the donor advised fund. So the assumption has always been that donors get deductions because they're contributing to charitable organizations that are presently engaged in good work of some sort or another. Whether that good work is relief of poverty, whether that good work is educational, whether it's religious in nature, but it's understood that you make the contribution to the organization, and that organization now has assets that can be used to further the purposes of the organization. Not so with the donor advised fund. They don't have to distribute. You dump the money in there, it can stay there. So, but you still get a deduction in the full amount, and none of that money is actually being distributed to any organization. It's also the same reason that Congress in the Tax Act went after certain educational institutions with very large endowments. Endowments that are so large that they never use the resources available from that endowment to actually benefit the organization. It applies to about 4 colleges in the United States, Harvard being one of them, Yale being another one of them, where the point of that is you're holding money just for the purpose of holding money, right? You're not holding money for the purpose of doing good work, you're holding money for the purpose of holding money. And so that's the concern that you see in donor advised funds. So one of the ways that has been suggested to address those concerns, one of the ways is to require distribution. So you have to distribute within a certain time frame. You don't have to distribute it all now, but you do have to distribute your fund over a period of time. Second, there has to be at least some, another alternative, there has to be at least some percentage that comes out of the donor advised fund, the individual donor advised fund, every year until it's exhausted. So one option would be, you got 7 years, for example, to spend it all out. Second option would be, you've got to actually distribute 5 to 7% of that fund every year. You can never have a year where you can't. Right?
Just give it to another donor advised fund. I'm joking.
It has to go to a charity.
Okay,
It has to go to, typically to an active charity. So you can require the distribution in terms of a fixed year. You can require the percentage, make it look a whole lot more like a private foundation by requiring distributions of a certain percentage each and every year. You can, this is another regulatory suggestion, to delay the deduction until you get a payout. So you can deposit as much as you want to in the donor advised fund, that's not deductible. When it becomes deductible is when you pay it out to an active charity. So if you put it in there in 2018, you get no deduction. In 2019, if they pay something out, then you get a deduction in the amount that is distributed. It's like holding on to it. Yes?
So I'm ignorant. I had never even heard of the donor advised fund, although I do belong to Fidelity. So I normally just give gifts to the church.
Right.
Right. So I understand you did talk about some of the benefits. I heard you talking. Can you give me a simple reason why I would use this donor advised fund at Fidelity versus me just donating myself versus?
Yeah, the reason that most people use is that they want to make gifts continually over a period of time, but they also want to have the flexibility to change who is going to receive that gift, right? And get my deduction immediately. So if I deposit $25,000 in cash in one of these funds in this year, then I get a $25,000 deduction. But I don't have to make a decision about where it's going to go until I'm prepared to make that decision, right? And so that's the reason. Now, most of the complaints, by the way, about donor-advised funds are about financial institutions managing donor-advised funds. So Fidelity has a large one. Schwab has a large one. Vanguard has a large one. Those are the concerns because there's so much wealth in those. However, there's an awful lot of donors in there. So according to Fidelity, their median donor-advised fund is under $18,000. That surprises me. I would have thought that the median would have been much closer toward 100,000 than 18. The median at Schwab was even lower than that. So maybe the concern is not as significant as some people think it is, but it does allow individuals of considerable wealth to get a tax deduction by putting it into this donor advisement and make decisions later and allow for successive generations to continue to make decisions about which charity should get it. And I think we can understand the appeal of that, right? Because we have all watched organizations wander away or intentionally leave their mission. So leaving that money to the organization in a generation may be problematic. This allows the individual to put the money in and year by year assess which organization is one which I can, in good conscience, distribute my money as a steward, right? That's the advantage of these kinds of things.
Is the end, again, then a better return on money that is parked versus?
Well, that's interesting because for example, if you wanted to give the money to a college endowment fund, most of those endowment funds are managed, right? And those are directed out and there are going to be distribution purposes assigned to that particular thing, and it goes to that one charity and it's not going anywhere else until that charity is dissolved. You're right. There's a lot of places where that money can be better managed, but if you're talking about a choice between an organization, a charitable organization that has an endowment, that endowment money is almost always managed either by an internal manager or an external chief investment officer. So, but you're right. Good question.
One other place that I've heard of donor advised funds being used is when there's a huge windfall in a particular tax.
Oh yeah, you're right.
You know, if like they were, a CEO retires and gets all these stocks and things, and so now they have $25 million of income for one year. They want to they can put $12.5 million of that into a donor advised fund. Right. And instead of having to give $12.5 million to their church or their college,
or make a decision now to get that
later,
give that 12.
But they can get the tax deduction now because they have a big windfall. So that's another time I've heard
that can be useful. That can be very useful, right? And those are the types of situations, however, where the critics are considering that to be not the public trade-off that deserves a deduction.
That's not why we gave the deduction. We want that to go to homeless people for food, not go to Schwab for a 2%.
Correct. That's right.
Right.
And that's right. That's exactly right. So what do we want? What do we give? Why do we give a deduction to individuals? Because we want to incentivize giving, not storing. We want to incentivize actually transferring through these organizations to the good purposes that they have in mind. That's why we give the deduction. So the $12.5 million that comes in cash that particular year, we're happy to give a deduction. Or after this year, you can even have more than that, $13.5 or $14 million. We're happy to give the deduction if it's actually being
If it
used.
gets to the homeless count.
Right.
But all you have to do is spend 5 to 7%, right? If you wanted it all, if you could deduct all 12.5 million, if you get one distribution, or do you have to distribute
You
it
don't
all?
have to do anything.
You don't have to do anything. You park it in the donor advised fund
And
that
you start-
year in
you
which you
start
make
getting
which
the
you make
gain.
the contribution, you get the $12.5 million deduction that year to your $25 million adjusted gross income number. So, and that's it. And it can sit there. And nothing else is required in order to get the $12.5 million deduction. And that's the big regulatory question these days. Is that the right thing to do in our circumstances or not? So,
For those of you who are advising any Catholic clients, this is going to be something that they would want to know about, because many of them up to this point have been, just giving it straight to the church, and now they still want to give to the church in some particular way, but they're not interested in giving it to the diocese, right? They want to give it to particular priests, or they want to give it to Catholic organizations that are very specific in their giving, and this would be the perfect vehicle for them to be able to do that.
it allows you to make that decision whenever you want to make the decision, and it allows you to make a change. As long as, by the way, these organizations, Fidelity, for example, or Vanguard, they have a list of approved charities or types. So you can't go outside those lists. They won't allow for that, which is fine, because remember, the whole point of getting the deduction is that you lost control. They own it, right? That's the whole point. You have advisory privileges. They're going to satisfy those advisory privileges if they can, because they're after satisfying not you, but the next client. So they're going to agree to those advisory instructions in most cases in the years to come.
So they have a limitation on which 501c3s, or?
They might,
Okay.
yeah,
All right.
yeah. You have to look at that. Are there things that are off lists, right?
We're the Baptist Foundation and the Kentucky Baptist Foundation, and we do donor advised funds. We can't give to Planned Parenthood.
Right.
Even if you direct us to, we won't.
Correct.
And I've played that out hypothetically with our president, and maybe we would give it to a different foundation and say, we can give it to the Louisville Community Foundation, and then you can direct them to do whatever you want with it. But we are not giving it to a pro-choice charity.
Exactly.
Because
And
that violates,
that's an appropriate way to do it. That's right.
our
Yeah,
way.
and that's an entirely appropriate way to do it. It's a little more problematic when Fidelity Charitable Gift Fund that has a whole list of all of these things, if they carve off some of them. But that's something to be aware of for clients in the future. You might see, I'm not sure that the culture wars can get any more brutal than they are right now. But if the culture wars become even more brutal, I wouldn't at all be surprised to see some of those organizations carving off particularly Christian charitable organizations, because they don't want to suffer the kind of public shaming.
It would not be far-fetched for Schwab to say we don't give to any hate groups of the Southern Poverty Law Center. But that would be the Alliance Defending Freedom,
Right.
potentially.
Right.
Or Catholic Right to Life, or,
Right.
some of those are hate groups.
Right.
But they say, well, that's our screening.
Correct.
We let someone else screen.
So every
those that are
donor
hate
needs,
groups.
every
You
donor
can't
needs
give
to
to
make that decision, needs to read that list and see what the rules are before that donor makes the deposit at the donor advised fund. And then you have a question. It would seem to me, I don't know the answer to this. You have a question of contract, because what if, when you make the donation, that particular charity is on the list, and now the charity's off the list? What happens in that situation? I think that's a contract question. I think it's a question of breach of fiduciary duty, whatever it might be. But remember, the reason, the justification for giving the full deduction is you have given up control, right? So I think, personally, that if Fidelity were to take certain organizations off the list, I don't think you got it right.
Yeah.
I don't think you have it right.
You don't have ownership.
Correct. You made the transfer, you got the deduction, You have advisory privileges. They are not required to abide by those advisory privileges, so you may end up with your second or third choice if that ever happened, right? So we won't distribute here, but we'll distribute to these organizations. And again, if they're in an embattled cultural war, I think that can be problematic. Okay. Now, outright contributions at death. You can do it mechanically, you can do it very easily. You can do it through a will or a revocable trust, simply by naming the charitable organization or the donor advised fund as a devotee under a will or a beneficiary under a revocable trust. You can designate a charity as the beneficiary of a payable on death account or transfer on death account that the decedent owns at the time of death. So there's a $50,000 savings account at the bank. You can fill out the form that says, pay this on my death to the X charity. And that simply transfers the property at death. It's simply an outright gift of some asset at death. Could have done it while you were alive, decided not to do it. That was the when question. Decided to do it at death. And the mechanics of that are really very simple. The donor advised fund comes in these circumstances to add some kind of flexibility. So if you designate the donor advised fund as the beneficiary of the revocable trust, then you have arranged with the donor advised fund to transfer advisory privileges to your children. Then the children get to make decisions about where the money will be distributed from that you deposited in that donor advised fund. Okay, ways to think about charitable transfers at death. And I borrowed this from a friend of mine, Michael King, at the National Christian Foundation. So, in conversations that happen between the lawyer and the donor, how can you think about the topic of making gifts at death? Well, one way to think about it is to think about it as a percentage of the estate. Have you been someone who has given 10% or more of your wealth away while you were alive? Yes. Would you like to give 10% of your wealth away at death to a charity? They might. That could be a very helpful way to introduce the topic of charitable giving at death. You can also say, why don't I give away everything that is in excess of the current transfer tax exemption amount? Now, the transfer tax exemption amount is big, right? So it's $11.16 million right now, or 1/8 right now, and so a couple would already be over $22 million. But there are people out there that have more wealth than $22 million, and so saying to them, is this enough to care for you and your surviving spouse, and to give or distribute to your children if that's what you want to do, and anything over that will be distributed to charities. That's a reasonable way to approach it. A couple of these that I hadn't really thought about before that Michael suggested were treating charities as an additional child. So whatever you intend to give to your children, add one, right? So it's 2 children, treat it as 3. We're going to divide the estate 3 ways. Each of my children get a share, and the charity gets a third. Have 5 children, you're dividing it 6 ways. So that's an interesting way to approach it, it seems to me, and actually a pretty helpful way, I think, for donors to think about what it is that they're doing with charitable transfers and death. This is also an interesting one. Giving and inheritance of giving. So the idea here is to take a child for example, and transfer property to the child, that's your money, and transfer to that child also the advisory privileges in a donor advised fund of a certain amount. So I want to give you money, but I also want to give you money so that you can give money. And so you actually make two gifts. One to the child and one to a donor advised fund that gives that child advisory privileges in terms of distributing that property. Second, or last one, is charitable giving by disclaimer. And, disclaimer planning is probably a pretty good thing to do these days in a world where the tax rules are likely to change with every election. So that you can make decisions at the last possible moment. So you could leave all the money to the surviving spouse, for example. If there wasn't a surviving spouse, then you could leave that money to a trust for the children or outright to the children. And you could provide that if any beneficiary disclaims an interest to be received at the death of the decedent. That beneficiary's interest goes to a charity or to a charitable fund, a donor advised fund. Now, is that going to work if you have children who think that they'll never get enough money? No, because they're never going to disclaim. But if you have children who are already charitably inclined, and in the midst of the conversation about what to do with our assets as a family, you say, look, I'm going to allow you to decide how much of this you really want to keep. Now, I hope that I have taught you how to be good stewards and not just holders and consumers, but good stewards. And so here's the plan. You take what you think is appropriate under the circumstances, disclaim the rest. And when you disclaim the rest, you have directed that it will go into a donor advised fund, and you get the authority to advise that fund about where the property is going to go over the next decade or two. I think that that's not a bad approach to things. But again, it's built upon the assumption that the people in the family already have a commitment to charitable giving. And they have a commitment that's beyond just acquisition and consumption. All right. All right, so other outright contributions at death. You can designate a charity as the beneficiary of a tax-qualified retirement plan. There is within the tax-qualified plan, you have this issue of it's never been taxed, right? And so when you die with holding the qualified plan, it doesn't get a step-up in basis like other assets do. So all the distributions that will come from that tax-qualified retirement plan will be income in respect of decedent. And income will be owed on every distribution to a non-charitable beneficiary.
Is that passed through by means of a K-1, a state return and a K-1, the beneficiary?
No, it could be if that's what happens in that, if it actually is payable to an estate, but it's oftentimes not. It could be simply payable to a beneficiary, right? Outright.
I see what you're saying. So they're going outright.
Right.
Outright.
Right. So now, if you transfer that instead to a charity, they don't recognize the gain on that. They don't have to pay the income tax, income in respect of a decedent. So what does that mean? It means that if you're in a 35% bracket, it means that you could actually increase your charitable gift by 35%. So instead of having the money distributed to the individuals who then have to pay the income on that as income in respect of the decedent. You distribute that money to the charity. The charity gets the, say it's 25% of a $1 million IRA. That charity gets $250,000. The charity does not have to pay tax on that $250,000. If the $250,000 instead is distributed to a spouse or a child, that spouse or child is going to have to pay income tax because it's a income in respect of decedent item. It's going to have to pay the income tax on that, which means you're going to reduce that $250,000 by 35% just at the federal level. In addition, you're going to reduce it under the state level by some extent. And so when the dust settles, assuming you have a 40% effective tax rate, you've lost $100,000 on this thing, on the $250,000. Transfer it to the charity doesn't suffer that consequence.
Is that limited to the 50, 60, or 30? Or can you give all 100%?
As long as it's being distributed, which in all these cases it would be distributed as cash income, right? So it's not transferring the marketable securities over to the charity. It's actually the custodian would be cashing out those marketable securities, turning them into cash, and then distributing from it.
So is it limited to 50%?
60 now.
Okay, but it's still that.
But that's
that would still be limited to 60.
well. No, so here's the difference.
It counts as income.
Yeah, here's the
and then it
difference
goes
though.
back out.
But we're talking about making a transfer now, and so you're talking about taking the $250,000, making that particular transfer in that particular year, right? That's not going to happen. You're not going to distribute $250,000 to the beneficiaries in most cases of those retirement funds in 1 year. You're going to distribute that over a period of time. You're going to stretch that distribution out over a period of time so that you don't have the big $250,000 income hit in that particular year. So you're going to do this. It's going to be transferred out of the decedent's estate. The income tax consequences will be non-existent for that particular thing at that particular time. It's entirely deductible. It hasn't been received by a non-charitable beneficiary. So there's no income tax to be paid. And you've reduced the transfer tax amount, possibly, and you've eliminated the extra cost of tax by transferring it to the charity. It's a thing that, again, it goes back to, we've made the decision when we're going to make these big gifts of death. Then the question is, what assets? Yeah. And so, in my mind, this is a really good place to look first. What about your retirement assets? What about the ability, would it work if, when you die, we give 10% of your tax-qualified retirement plan, 10% to the charity? When the spouse dies, who will be the recipient, the beneficiary of all the rest, when the spouse dies, in that spousal rollover IRA, we give another 10%, right? That seems to make sense to me because, again, we're talking about what assets provide the most efficient mechanism to accomplish the charitable purpose. And in my mind, this is a great asset because this asset, if you hold it, is going to cost you 40% if you're getting significant, if you're at that level, right? It's going to cost you 40%. Why not give the asset to the charity? They don't have to pay. They don't have to cut 40%.
So basically, $500,000 estate, I've got $100,000 in an IRA if you want here.
Right.
And we basically, in the will, you can designate that.
You do it by beneficiary designation on that form. Go ahead.
And that the X percent or X number
Right.
of dollars
Right.
first must come out of the IRA,
Right.
and then the balance can come out of.
Yeah, so in most cases, you would not have the estate as the beneficiary of your IRA. You'd have a spouse as the beneficiary in many cases. So what you would do in that situation is you'd execute, this is the mechanics, you'd execute a document with the custodian of those tax qualified or IRA monies and designate a percentage of that to go to the charity that you've chosen. And so what happens now when that IRA is to be distributed or rolled over, 10%, my hypothetical, 10% goes over here to the charity, the other 90% rolls into the spousal IRA. Does that make sense? And so what's the advantage of that? The advantage is if that spouse is in a high tax bracket, you're talking about saving probably pretty close to 40% if you transfer that asset rather than cash at your death, right? Or other security at your death. If you have marketable securities in a brokerage account, what happens at death? Those marketable securities get a step up in basis. So they now have a basis of the fair market value as of the date of death, right?
For free.
For free. Not so with the IRA, right? And so there's still 35, depending on your bracket, 10 to 40% somewhere in there of built-in tax cost that you can avoid if you make, instead of making a $100,000 gift to the charity from your estate, make the $100,000 gift out of the IRA.
You get the deductions through your whole life, and then you give it up.
Exactly. Right. It's a great way to do it. And I think that you'll see that it will become more and more a custom of doing that way. Again, we're at a stage where baby boomers who have, this is really the first generation that did a lot of retirement savings, if they have. And so you're now getting to a place where you have the first generation that has made retirement savings something of a priority, and what you do with the planning of distributions of those tax qualified monies at death. And charities are a really good way to think about using those tax qualified monies. All right, split interest gifts. So split interest gifts are transfers that divide the interest in property according to time, assigning one interest to a charity, assigning the other interest to a non-charitable beneficiary. The interest to a charity could be the first interest, which would be the income interest. Or it could be the last interest, the charitable remainder interest. Could be either one. That's a split interest gift. They can be very useful for planning purposes, and they'll fit a fair number of charitable planning scenarios. But the thing to remember is form drives all of this. Whenever you're talking about a charitable lead trust or a charitable remainder trust, you're talking about hitting the form right. The mechanics are really important. The service outlines exactly what it is that you have to do in order to take advantage of this sort of thing. So, they have to be annuity trust, charitable remainder annuity trust, charitable remainder unit trust. They cannot be charitable remainder income trusts. That won't qualify for the deduction. You can do it if you want, but you get no deduction for it. And it's not that hard to do it the right way and take advantage of the deduction things. So, charitable remainder annuity trust, that's simply providing that the non-charitable beneficiary takes the first interest in time and takes that interest as an annuity, a fixed payment for a period of time. Might be life, might be a period of years. The The tax benefit to the donor is that the donor who creates this charitable remainder annuity trust gets to deduct the present value of the interest that the charity will receive after that annuity period. At death, the donor's estate can deduct the present value of the remainder interest that goes to the charity, so you don't have additional transfer tax consequences, no capital gains recognized on the transfer of assets, and there's some more matters in there about how do you treat the annuity payments on to the non-charitable beneficiary during that non-charitable beneficiary's life. You can also have a CRUT, a charitable remainder unit trust, and the difference here is instead of having a fixed dollar amount, you actually have a fixed percentage of the trust distributed to the non-charitable beneficiary to be established on a particular day of each year. And again, that can be for a lifetime, it can be for a term not greater than 20 years. And the requirements here are that it has to be at least 5% of the value of the trust, but not more than 50%. And then you have these things called NICRUTs, net income, charitable remainder unit trust, NIMCRUTs, net income with a makeup provision, charitable remainder unit trust, and which allow for some flexibility in years when you've had a bad investment year. And you don't want to distribute out 6%, for example, in this year when you've had a 1% return on the money. So you can, under those circumstances, actually distribute out the net income and then owe the rest. So that in any year where you have more than the 6% return, then you make up what it is. So, anyhow, all of that is detailed beyond what we really need to know. The advantages, again, to the donor are you get a deduction of the present value of the remainder interest at the end of the term that's been set. Pooled income funds are another option. Anybody ever see a pooled income fund, or even, does anybody? Yeah. Pooled income funds are typically used by large institutions that will manage their own money. And so you can deposit your money with that pooled income fund, and you get to take your pro rata share of the return of that fund. So if you think of the pooled income fund, it would be the charity, in effect, managing a mutual fund. And if you own 2% of the mutual fund, when that mutual fund, owned and managed by the charity, recognizes its income, you get 2% of the income. Got it? Not common, but it is out there. What's the advantage of it? The advantage of it, you don't have to manage your own money, which can be an advantage. You can take advantage of whatever leverage there is by an institution having a large amount of assets that can be managed and maybe reduce fees by that, get better investment advice as a consequence of that, etc., and you get a stream of income. Now, what you don't get is you don't get a fixed stream of income. You get your 2% of the income generated in that fund in any given year, if that's what your contribution represents. But it can be useful. Now, charitable gift annuities. Charitable gift annuities get combined with the other split interest types of charitable transfers, but they're really not a split interest type. Here's what they are. They're a donor who makes a contribution to a charitable organization. That's the transfer. Now the charitable organization has all of the money. The donor doesn't have any interest in that money whatsoever. The charity promises by contract to pay the donor some money, a certain amount of money over a period of years or life. Got it? So it's not that it's actually a split interest. We haven't taken an asset and said, you get the first 20 years and you get the next X number of years, or all the rest of the years. It's actually one transfer with a contract in return. The IRS does not set the annuity rates. There is an organization that sets the annuity rates, and that organization, the
American Council on Gift Annuities.
Thank you.
ACGA.
Yeah, American Council on Gift Annuities, which has changed the rates just this spring. Now those rates, taking account of increased mortality, taking account of changes in the amount of return that entities are likely to get, those things have changed, making sometimes the rates more favorable to the donor, sometimes less favorable to the donor. They can be very useful, and it's surprising to me that more organizations don't do more of them. And I think the reason for that is this. The organizations just don't think they're big enough to be able to handle it. Because what have they done? They have put themselves at risk because they have to make the annuity payments for the annuity period, whether that's 20 years or the life of the donor. And so they're a little uncertain about that. Can we do that? Is that a good thing for us to promise? Well, one way to address that situation is to use, and it won't always work out financially, but it's at least a possibility, use a commercial life insurance company to fund the annuity. So example would be this. You get a donor who's going to give you $1 million, and then you're going to promise that donor $5,000 a month for the next X number of years. You don't want to be on the hook for that as the charity. Well, buy an annuity contract with a commercial carrier who will take on that responsibility. So now you've got the $1 million that you got, right? And now you've got this stream of payments that you have to fund. You go to the life insurance carrier and you say, what's this going to cost me? They promise to do it. Now what you do is you got the $1 million, you transfer part of that $1 million to the insurance company to pay that, and now your cash is free, right? That can be a useful way of doing those kinds of things. And I think it allows organizations that are small to be in the market of doing charitable gift annuities if they want to, by using commercial carriers to do it. Okay, this is just a matter that it could work sometimes, and we've got a couple minutes. Okay, so some people are, and maybe you've seen this or heard about this, some people are a little concerned about doing a transfer that has permanent consequences to their estate and what it is that they might be able to transfer to a surviving spouse or to children. That makes them reluctant to make any transfer until death. Because they just don't know what will the circumstances be when I die. How much can or can't I afford to give to a charity? So one of the options is to wait, right? Just to wait and make a transfer at death, and or give somebody a power to disclaim and allow any amount that's disclaimed to go to a charitable organization. You just wait. Another way to do it is to actually have a charitable remainder trust and then fund typically a life insurance policy with the amount of money that comes back from the charitable remainder trust. So the situation is this: you transfer property into a trust for a charitable gift annuity if you want to. You get payments that come back. If you don't need those payments, which in some cases you won't, and the reason you were reluctant was not because you didn't have enough money now, you just weren't sure you're going to have enough money later to give the gifts that you wanted to give. So you take that money and you go into the commercial market and you buy a life insurance policy on yourself with that money, for example. When does the life insurance pay off? That pays off at death. When does the asset get distributed to the charities? At death. So now you've replaced a good bit of the value that you already gave away, if you're already concerned about potentially not having enough money to distribute to the people whom you love and who you would like to bless with that money. That's one way of doing it. Now, there are lots of insurance agents that are going to sell clients on this option because they like to sell insurance.
You get a commission.
And they get a commission. But it's also the case that in some cases, it actually is a very useful thing. Just because somebody suggests it doesn't mean that it's a bad idea. It could be a very good idea under the certain circumstances. So it's something to at least consider for the reluctant giver. Not because they don't have enough, but because they just are afraid of what can happen. And they really do want to give some kind of legacy to their children and maybe to their grandchildren. So that's a possibility. All right. Charitable lead trusts. Now, charitable lead trusts are those situations in which the charity gets something. The charity gets the first interest. They get the annuity interest. They get the unit trust interest, just like the flip side where the non-charitable beneficiary got that in the charitable remainder trust. And these things can have a place. There is no minimum payout required for these things. So you can give the charity whatever interest that you want to give. The more interest that the charity gets, the bigger the amount of the charitable deduction will be. Go to the last line up there, planning opportunities. When U.S. Treasury rates drop, now that hasn't happened in the last few days. They've actually gone up, right? But when Treasury rates drop, that 72.20 rate, which is the rate that you use to determine the amount of the present interest and the amount of the future interest, when those drop and you multiply the rate by the 72.20 interest, the present value of the charity's interest will increase. And so, in places where rates are dropping, charitable lead interest might be very useful techniques. In places where interest rates are rising, they lose a lot of their luster. Because what happens is the charitable interest gets reduced and the future interest that the non-charitable beneficiary would get gets increased.
And again, I should maybe know this, but does the present value of the interest, is it determined as of the date of the creation of the trust? So essentially, you're looking
Funding, right.
Funding, so essentially, it's a one-time termination.
Correct.
It
That's
doesn't
exactly
vary,
right.
You're just looking for
That's
the
right.
time.
You're getting
Rates are
that.
low.
You're getting that charitable deduction in that year. It's the present value of the transfer.
So we're looking, they work well when the rates are lowest. is what we're saying, essentially.
Right.
And the 75/20 rate is what I've heard called the IRS discount rate. Are we talking about the same thing?
Yes.
Okay.
Yeah.
Okay. It changes every month.
Correct.
That's the 70.
Correct.
I didn't
That's
know
right.
it was 75/20.
Yeah.
I just have in my mind as the IRS
Yeah.
discount rate.
That's right. It changes every month, and
The smaller it is, the better
yeah,
CLT.
it's based on yes.
Okay.
Well,
Right.
correct. When the rates go down, it's
The
not
bigger the rate, the better the CRT.
correct. Okay. Right. All right. That's it for me. We hit our mark.
Stick a fork in you.
Thank you very, very much.